Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
When you retire, there will be 12 types of income that you could collect. Do you know what they are? You heard me, 12 different sources. Well, if you don't know what those are, or you're thinking about retiring next year, or maybe you're already retired and could need a little bit more income, then this show is just for you, as we're going to go over retirement income made easy. For those of you just joining us for the first time, welcome, people around here. You hear the jingle, they call me the Sandman. That's because I help my listeners sleep well at night by helping you keep more of what you work so hard for. And that's because I've been running a tax, legal, and financial planning firm. When you retire, do you know how much you're going to pay in taxes on your income? Did you know income like your Social Security, your pension, dividends, 401k distributions? Well, these all could be taxed differently, and if you don't know the difference, you could end up paying a lot more in taxes than you otherwise might. Who wants to pay more in tax than what's necessary? Well, join us today for the entire show as we're going to share with you Retirement Income Made Easy. It's going to be a great show, so keep it right here. Now, let's get started. Well, this past week, inflation looked like it was ticking up. So with that report, do you think the Fed's going to still lower rates next week? Well, for the week, the Dow Jones was off 1.8% on that prospect. S&P 500 off about almost 0.5%. The NASDAQ, well, we did hit 20,000 this year. We settled in at 19,927, up 0.3% for the week. NASDAQ's the big gainer for the year, of course, with all the tech heavy, 32.7% up. MSCI International up 4.6% for the year. And the 10-year Treasury, this was the big surprise this week, closed at 440. The trading range was around 410 to 420, broke out to 440. Why? We'll talk about that in a minute. Oil, partly responsible, up over $70 a barrel for the week, $71.18, up almost 6% on the week. Again, international Middle East turmoil. And bonds closing at 97.92. So the question I received is, with inflation looking like it's ticking up, do I think the Fed will lower rates next week? You may have heard this past week in the financial media that the Consumer Price Index, that is the measure of inflation, it was a little bit hot, because the headline number rose 2.6 to 2.7%, and the core inflation remained comfortably above 3%. At 3.3% year over year. So was that accurate? Is it accurate that inflation is getting worse? Well, I don't think so, and here's why. Here's the main reason. You may want to research this, called the owner's equivalent rent. What does that mean? Well, that is one of the biggest measures of housing costs in the Consumer Price Index, and the owner's equivalent rent rose just 0.2%. This was the smallest increase that index has seen since April of 2021. So that report, I think, will increase the confidence in the Fed this coming week that inflation will get back to the 2% target. So for those of you looking to borrow capital, use capital to improve your working environment. You might want to just hold off a little bit longer, because from where I can see it overall, the confidence from CEOs across the country is heating up. What do I mean by that? Well, they have this thing called the National Financial Institution Board, NFIB, Small Business Optimism Index. This just came out last week too, and that index saw the largest, get this, month-over-month jump in 30 years. You heard me right, 30 years. And this is the business owners, small business owners, looking at the prospects for more tax cuts and what they call pro-growth policies, lower regulations, things like that on business. Capital spending that could have been delayed because of an uncertain election finality has now ended, of course, and we're seeing that 2025 and beyond when it comes to small businesses are pretty positive. This should help manufacturing. It should help more strong economic momentum and stock prices overall. So even though borrowing costs with the 10-year that we just saw may remain a little bit higher for longer, and this could certainly damper some of that pent-up demand, the valuations overall in stocks could continue to rise. And with the, we'll call it, winning ingredients still in place, like wages are still rising faster than inflation. You have an economy that continues to add more jobs, and corporate profits, well, let's face it, they are accelerating and growing, and the enthusiasm now shown by this index for those running small companies with AI still alive and well. Historically, when you look at the third year of a bull market, tends to be a little bit choppier, so I would expect, again, more volatility. So if we continue to see outside countries like the EU, we saw their EU index drop this past week, saw Canada drop, Switzerland, these independents lowering rates, that makes the dollar weaker, in which case the international indexes, like I mentioned, the MSCI index year to date's up 4.6, for the week was off 0.7. Now getting back to our subject today, if you are at or near retirement, or maybe you're thinking about retiring next year, well then you're thinking about income, because once you stop working, the paychecks are going to stop, and so you're going to be looking at the traditional three-legged stool to create income that you can pay your bills with. Well, what are those? You have Social Security. You have possibly a pension if you're lucky. If you don't have that pension, then you're going to use your 401k to supplement your income. And if you do have a pension, well, then you've got that traditional stool. If you don't have the pension, then you're going to have to do it yourself. And so people think about, well, maybe there's only 3 sources of income. But that's not necessarily true. There's many different ways to create income. And so one of the first ones that I would encourage you to take a look at, if you haven't done this yet, is what I call prioritizing passive income. What do I mean by that? Well, you could add to your portfolio real estate. And real estate comes in the forms of rental homes, mobile home parks, apartment complexes, industrial real estate, storage. These can all be invested in passively, where you don't have to be an active manager of the real estate, and that can produce income that is possibly tax favored when you look at how it is paid out and what's behind it. Certainly there's lots to consider there, but the key investing in these assets could be to maintain appreciation in value over time, because not only will you continue to receive dividends, as long as, again, you got to read all this, but as long as they're producing positive cash flow, then the real estate could appreciate in value, and the manager of that real estate could eventually sell that at a gain, potentially. Then that could be a source of passive income to supplement your overall monthly income as you retire. So that's something to consider, as if you own rental real estate, or maybe you're thinking about getting out of the real estate that you've owned, because let's face it, in California, it's become much tougher to own real estate with rent control in every county now in California, and certain restrictions and costs just to improve and keep up with what's going on, and then lawsuits and everything you got to do to stay in front of all that. It just becomes super expensive, obviously. So you might want to look at some third-party source that could either manage that real estate by a 1031 exchange, so you could sell your property at the current high values, exchange into 1, 2, 3 properties of different types of classes across the country with more favorable regulations, more favorable growth going on in that environment, and then create more income by having better multiples, better net operating income when you consider the overall return. So don't forget about that if you haven't really been considering that, if you've done real well and have accumulated real estate and you're not necessarily getting above a 4% return on your investment, well, you should be looking at it. And it's pretty easy to figure that out. We can take a look at your Schedule E. We can deduct the rent and all the cost of running it from your total cash return and figure out what your return on investment is. And if you've been sitting on it because you just don't know what to do about that capital gain, well, it still exists where you can exchange into another type of property. And then with today's current capital gain step up in basis, you could pass that property on to your family with a step up in basis and not pay tax on that capital gain if they went ahead and sold it at the appreciated value upon one of your deaths. So there's many ways to look at this, and if you're not certain about it or you're just not sure, maybe you built a real estate portfolio and you're trying to pass it on to your kids, but they don't necessarily want it, then I would encourage you, particularly while the estate tax is still pretty high. Remember, it's about $13.6 million per person right now. You could do some very good tax planning and estate planning and income planning on top of that. So you've now created another source of income that maybe really hasn't been doing its job lately with all the things we're dealing with here in the state. Coming up next on Protect Your Assets, is it better to take your Social Security first or your pension? We'll find out when I come back. You are listening to The Sandman on the Protect Your Assets show. We will be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and our goal here is to help you live a more productive, less stressed life when it comes to your money, taxes, or passing on what you work so hard for to your family. I have yet to meet a person who wants to pay more taxes. Everyone wants to keep their tax bill as low as possible each year, and if you don't understand how your income, especially in retirement, is going to be taxed differently, then you could easily wind up paying more in taxes. I was sitting down last night with my mom looking at her statement, and this was from Social Security, and of course it was going up on her Medicare tax, and this just came out of nowhere. So too often we see someone withdrawing money out of a higher tax account versus a lower tax account. We see retirees withdraw money in the wrong order, causing them to pay extra taxes. We see people claiming their benefits too early or too late, not being tax smart. And guess what? Do you think they end up paying more taxes in the long run? Well, yes, they do. So stick with me, as today we're going to cover how to make your retirement income easy. If you missed any of the first part of the show, particularly the market segment, then go check out our podcast on Spotify or iTunes, wherever you get your podcast. Just type in Protect Your Assets, and you can click on either the show for that day or you can click on the market segment. Again, Protect Your Assets is the name of the show and the podcast. And I'd appreciate you sharing that with your friends if you find something that you like. So let's start with the most common source of retirement income. What is it? Social Security. You bet. You paid into it. You paid all kinds of taxes on your pay stubs. You probably remember that. And the question is, will you pay taxes on it again? And I hate to tell you, most people that we meet with, the answer is yes. They could pay as high as 85%. You heard me right, 85% of the Social Security benefit. Well, how does that work? Well, you've got to first of all determine what is your, they call provisional income. And I know this is kind of boring, but you may want to pull out your tax return and look at it. You go take a look at your 2023 tax return when you get a minute and go to line 9. Why do I care about that? Line 9 on page 1040. Why? Well, because that's where they add up all the taxable sources of income. And you have to be aware of this. If you don't, or you want to pay less in taxes on your Social Security. If you pay more taxes on income, you keep less. You have less in your pocket. It sounds so obvious. So how does everybody fall into this trap? So let's figure it out this morning. If you are single and you have $25,000 or less, or you're married, filing jointly, and you have $32,000 of this line 9 income or less, then you're in good shape. You're not going to pay taxes on your Social Security. But if you fall above that, so let's say you're single and you make between $25,000 and $34,000 of line 9, or $32,000 to $44,000 for joint filers there in line 9, then 50% of your Social Security benefit is going to be taxable. You heard me, 50%. Now get this, because this is most of the people we see here in California. Just to afford to live here, if your provisional income as a single filer is more than $34,000 or joint filer is more than $44,000, then get ready for this, up to 85%. You heard me right. 85% of your Social Security benefit could be taxable. Wow, that's a lot. Now compare that to a pension, because remember earlier before the break we were talking about, should you take your Social Security first or your pension? Well, pensions are taxed as ordinary income. Whether you have a private or a government pension, they are fully taxable at your ordinary income tax rate when you receive it. So is it better to take your pension first and wait for Social Security? That is a really good question, and it really depends on your situation and your health. What? Yeah, your health. So how do you figure out which way to go on that? Well, you should get help, and we can help you do that. We can look at these sources of income, your health expectancy, by talking to you about some health metrics that are out there that you can measure, and make a decision. Now, what about your 401k or your IRA? What about that? When should you take that? Could that be the main source of income in retirement? It might be. Well, let's first examine how are traditional IRAs or 401ks, how are they taxed as you start to pull money out of them to live on? Well, remember, as you were accumulating it all those years, coming out of your paycheck, sticking it into that 401k account, you didn't pay taxes on it, right? It was tax deferred. It was stuck into that deferred account and it got invested, and hopefully it's been growing all these years you've been doing that. And so you saved money on that when you earned it, but when you go to take it out, those savings, the dividends, the appreciation in those accounts, well, guess what? That's going to all come out as ordinary income when you start those withdrawals. And you may want to delay it. Some people can delay it if they don't need it. And so they wait till what? Well, the required minimum distribution. This is called the RMD. This starts right now at age 73. People who work past age 73 and have a 401k, well, you can still delay taking that RMD from your current employer's 401k until you retire. But this is providing that you don't own 5% or more of the company that you work for. But when you start to take the withdrawals out of that IRA or that 401k at age 59 and a half or older, well, that's going to all come out at ordinary income tax rates. And if you take it out before 59 and a half, subject to some of the rules, you generally will be slapped with a 10% early withdrawal penalty on top of the ordinary income tax rate. So you could be looking at some pretty substantial taxes on that type of an account. So do you know it might make sense to possibly take that withdrawal before your 73rd birthday? This is where you start thinking a little bit differently as you get into retirement. Should you delay your Social Security and take money, say, out of your 401k when you're age 60? Good question. Well, the answer is very particular to your situation. So one way to make sure you're doing the right thing with your retirement is to know if your 401k and or your IRA is on the right track, to think about this one, to provide you with the income for life that you're going to need to keep pace with all of your expenses that keep getting higher with inflation, and at the same time keeping your taxes as low as possible so you keep more money in your account that you can spend on your lifestyle. Have you ever thought about how to get more out of your retirement income? Maybe you're retired right now and you feel like you're not getting enough, or you're not sure how to get it out of what you've saved. Then you might want to think about what else could you do. And remember, don't just sit there hoping, because hope's not a strategy. If you aren't sure about how you can save taxes on that income as you start to pull it out, or as it's even growing, then you might want to look at this a little bit differently and get some help. Remember, we have attorneys, we have CPAs, and we have certified financial planners who work together as a team to help you figure out what you should do. You know, when you're in the red zone and you're ready to make that touchdown, having the right team makes it all possible. I think back to last Sunday, and wow, what a great game that was. But you know, the team was really on that day, weren't they? And they were just looking so good. So if you have the right team, you have the right coach, a lot can happen, and it can be very positive. And remember, you can't get a second opinion from the person who gave you the first opinion. So now might be a great time for you before the year end to get an objective opinion by taking advantage of my on-track retirement review to make sure that you're getting as much as possible out of your account. If you want to take advantage of that right now, this will absolutely be complimentary, but you have to call me right now, 866-PROTECT. I've got Adrian sitting there right now, Adrian and Lucas. Call them right now and say, hey guys, I want to learn how to get more income. 866-PROTECT. Give them a call right now, 866-PROTECT. Coming up next, it is time for our popular They Say segment, where they say income that comes off high yield savings right now, well, that's better than CDs when it comes to overall total return. Is that true? Well, I've got an answer that's going to surprise you, particularly right now. There's so much more to come. You're listening to The Sandman on the Protect Your Assets Radio Network. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander. Well, here's something. We are getting ready for the new year. I can't even believe where we are right now, but yep, it's almost over. You only have a few more weeks left to take advantage of 2024, and then it's gone. And so the first part of January, we're already setting up for your tax returns that'll be due in April. If you want to get in front of that right now, I know you're busy running around holiday shopping. Well, you can register for one of our Tax Smart retirement dinner workshops. It's coming January 9th. We'll be at Perry's in Larkspur at 6:30 p.m. on January 9th. You can register right now for that event. Go to our website, libertygroupllc.com, libertygroupllc.com. You can click on the events tab, and when you land there, you'll see there's a blue register button. And if that day doesn't work for you, well, there's several more there that you can register for that maybe fits into your schedule or your location in California. We are spread out now throughout the state, so if you want to jump on one of those, go check it out, libertygroupllc.com. So now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes, well, bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
Yep, so here's one I heard they say this past week. They said that a high-yield savings account or high-yield junk bond is paying more than CDs right now. And is that the best way to go, or to take that kind of income after tax? So what do I have to say about it? Well, I got a lot to say about it. Let's talk about it. when you talk about high yield or junk, we're talking about things that are not investment grade rated typically. That's what that means. And so if you were around in the 80s when a lot of those were self-destructing and falling apart and defaulting and all those sort of things, what does that mean? It means that your principal could be lost. It means that even though you're getting a better rate of return compared to what's out there, these are examples, this is not actuality. I'm just using this for example's sake. Let's say that on a high yield return, you're getting 7%. And on a normalized return, like I mentioned at the start of the show right now, the 10-year treasury closed Friday at 440. That means on a 10-year treasury, as of last Friday, 4.4% was the rate of return on that investment. Well, 7's a lot better than 440. And so you might say, well, that's just better. I should go with the 7. But you got to look at the quality of what's behind that investment. And is it secure? Could it go out of business? Could it default, in which case you lose all your principal? That probably wouldn't be a good result for you. So that is very important to consider about the backing of whatever it is that's paying you that payment. Now, the next thing you want to know is, well, what are your ordinary income tax rates? And how do those apply to any interest payments you receive, say, on your CD, your savings account, or your money market, or in this case, the junk bond? You got to look at the after-tax return. So if you are paying high tax rates, you might right now want to consider something else. This would where I would say take a look at municipal bonds. Again, bonds have risk, so know that. But know this, municipal bond interest is federally tax-free. And if it's the right kind of municipal bond, it can also be state tax-free as well. Remember, capital gain rates may apply if you sold your bond at a profit. And this could happen if, as I was talking about at the top of the show, rates continue to fall. So how might you want to think about this type of an investment, or when you're looking at your, say, your bond portfolio, how might you think about this before you jump in and do that? Well, let's look at some theory. This is not actuality. I'm just using round numbers to keep it simple. Let's say you're looking at a 1-year CD right now and it's paying about 4%. You live in California, and with state and federal tax, your combined tax rate is 40%. So after tax, you actually earn off that 4% CD 2.4%. Question, is it better to buy a California municipal bond that's paying you 3.5%? Well, it might be. Because the tax on that, remember, if it's a California muni bond, at least the tax federally and state would be tax-free. So 3.5 would appear to be better than 2.4%. What about a tax-deferred investment? Let's say you get 5% or better. There are some out there right now paying more than that, where you could get tax-deferred interest. What about that? Could that be better? Well, it really gets down to how you use that income in retirement, and this is very important when you take it. Because if you have time to let that grow and compound tax-free, or maybe you designate one of your buckets to pay out, say, 10 years from now. So assuming you build an income stream right now for the next 10 years that with inflation adjustments keeps pace with all of your expenses, so at least you're sitting in a good position. 10 years down the road, if you think inflation will make the cost of things go up, which I certainly do, then you would want another bucket of money to, say, kick in and supplement your overall income. So at that time, you have more income to cover the expenses that have gone up. You could do that with some of your mid-range money that could grow tax deferred until you need it. And there are types of investments that even if you reached age 73, you wouldn't have to take them out at that point in time and let them continue to grow and compound. Another area, remember, we're talking about all the sources of income that you can create. Another area of income that you could create is maybe you have a life insurance policy. Maybe you've been sitting on a life insurance policy for years and you really never looked at it as an investment because it was just there to supplement your mortgage payment if something happened to you and you wanted your spouse to be able to stay in your home. Now you're looking at retirement, you're in retirement, and you have this life insurance policy, and you may have the ability to take tax-free income out of that policy and use that to supplement your overall lifestyle, and that comes out all tax-free. That's right. So that's another way to do it. What about your stocks, bonds, mutual funds? Well, if you sell those right now before the end of the year to lock in the gains that you've realized, that might be a smart move. Long-term capital gain rates are, if you hold it for longer than a year right now, they could be 0%. You heard me right, 0% on that gain. Take a look at that while that still lasts, 15% or 20%. You want to compare these figures to the top ordinary income federal tax rate of 37%. The 0, 15, and 20% rates on long-term capital gains are based on income thresholds that adjust annually for inflation. So we want to look at that. We want to take a look at what you're doing and how that's working. Don't forget about the 3.8% surtax on net investment income as well on those capital gains rates. And particularly now in California, if you go over $1 million, the 14%. If you're wondering about how all this works and what you can do right now to squeeze every cent out of your investments right now and keep more in your pocket, then do this. Stop worrying about this. Pick up the phone and call me right now, where we can run a simulated tax projection for you now before it's too late. Call 866-PROTECT. Again, 866-PROTECT. You got Lucas, you got Adrian sitting there right now. Call them right now. We have great coffee. We have free parking, a friendly staff to greet you when you arrive. We're local. And if you want to meet virtually because you're busy running around, we can do that too. Call us right now, 866-PROTECT, and find out how to keep more in your pocket. It's time for a quick break, but when I come back, how is your primary residence taxed if you sell it and move to another jurisdiction? Find out. You're listening to the Protect Your Assets show. We'll be right back.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now back to Protect Your Assets with David Hollander, the Sandman.
We're back. I'm David Hollander, and you are listening to Protect Your Assets this morning. And we found that the number one key to retirement, well, it's how you create income in your retirement. Because let's face it, big swings up or down in the market can cause you to make some bad decisions, and in some cases just run out of money and have to sell possibly your biggest asset, your home. So our job is to help our clients increase the certainty with their money, so when the next bear market strikes, you don't run the risk, well, making some of those bad decisions. During today's episode, we've been sharing how you can get more income out of your accounts, how you can think about taxes when it comes to your income, and I want to finish with probably your biggest asset, your home. And so let me direct you to a website first, boe.ca.gov/Prop19. Again, boe.ca.gov/Prop19. For the ways your home is taxed now in California if you go to sell it. There is something called the frequently asked questions right there on that website. As you scroll down in the middle, you'll see it. And a home is usually the biggest and most valuable asset, particularly in California, that you own. When you sell your primary home at a gain, which a lot of people are sitting on right now, if you have owned and used the property as your personal residence for at least 2 out of the last 5 years before the sale, you can exclude up to $250,000 of gain from that income overall. If you're married, double it to $500,000, and any gain above that $250,000 to $500,000 exclusion, if you've held it for over 1 year, becomes a long-term capital gain tax. Losses are not deductible. But what if you want to stay in your home but just can't afford to do it? Well, you need some cash, and all that money right now, it's tied up in the ground. What can you do? Well, there's something called a reverse mortgage. There's also something called an equity sale. Payments that you get from these are treated as non-taxable loan proceeds and not income. Also, know this, you cannot deduct the interest that you eventually have to pay when you satisfy the mortgage unless you use the original proceeds to buy, build, or substantially improve that home securing the loan. So think about that. If you're not sure about how this works, or you're thinking about passing on that residence to, say, a family member, maybe a rental property, there is this thing called Prop 19, and you really need to get educated about how that works in California, because many people don't know anything about it until it's too late. This was a proposition that was passed back in November of 2020 that was called the Home Protection for Seniors, Severely Disabled Families, and Victims of Wildfire or Natural Disasters. And when you went to read about it, you saw, well, it really had nothing to do with that. It actually had to do with your home. And when you go to sell your home or your property, how that gets reassessed if you're passing it on to your family. So that's what that's all about. And again, right in the middle of that, they've got a comparison chart. They've got some guidance. They've got a frequently asked questions. There's some related legislation that just occurred this past November when it came to Prop 13. So you really want to get a handle on this if your goal is to maintain your standard of living through rents off those properties. And perhaps you have a couple real good properties in your portfolio and you want to keep those in the family and pass them on to your kids so they get the benefit of all that hard work you put into it. If you haven't done any planning around this right now, you need to, because when it's too late, it's too late. And at that point, all the taxes are going to come down on it. So now is the time to get those questions answered. I know you know in the back of your mind there's a nagging question. Am I good? Is everything okay? Are you wondering about that? Do you really know for sure? Figure out how to get more out of what you have right now, how to maximize your income. Call us right now. That's what we do every day. 866-PROTECT. My team standing by right now to help you get over the finish line. 866-PROTECT. Call us now. 866-PROTECT and get so much more. I'd like to give a big thanks to the Protect Your Assets team for the entire show we put together today and for the year, all the great work you guys have done. Thank you very much, Executive Producer, Network Manager Kevin Renfer, and of course, all my fabulous producers back there right now, Phil, Adrian, Lucas, Raph. Thanks, guys, because without my team, well, I'm just another pretty voice on the radio. Thanks again, everybody. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life, and happy holidays.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.